Hey guys, I wanted to get a quick video out about something that I just saw. It's not getting a whole lot of mainstream media attention, but at the end of the day, it's pretty important, and I wanted to point this out to folks. So Moody's, which is one of the major rating agencies, just cut the ratings for 10 small and mid-sized banks and announced some other things. They announced that they're looking at some of the biggest banks for potential rate cuts. US Bank and BNY Mellon and State Street, which are some of the biggest of the big. And they've also adopted a negative outlook for a number of other large lenders. And so I wanted to get a video out, one, to talk about kind of what's going on, and then two, what that means for you, or what should that say to you if you're watching the video or you're hearing about this at this point. Hi folks, I'm Antonio Cibella. I'm a financial advisor with Vision Wealth Management. I've got the YouTube channel here to share information with my clients, as well as folks that just find me on YouTube and are looking for retirement information, financial planning, that sort of thing. Today, not really about financial planning, but about a news item that I just read that I think is important enough that I wanted to record a video about it. So, the banking sector, if you remember earlier this year, we went into banking crisis mode. We had some bank failures. I did some videos about that. Matter of fact, in one of the videos, and I'm going to point to it right up here because I'm going to put it up on the screen. One of the videos I recorded, I distinctly said, I don't think this is the last one that we're going to see. And then it kind of got quiet. And while we're not on the doorstep of bank failure, when you've got a ratings agency cutting ratings, they're saying, hey, things are getting worse for banks. That bears looking at, and then you need to see how that might apply to your own financial situation. So again, kind of what's going on here is, as the Fed really raised interest rates, it becomes more expensive for banks to bring money in the door. They've got to pay you more money on savings and CDs and things like that than they used to before the Fed raised interest rates. But they can't just immediately raise rates on all the people who already have loans out there with them. That's where they get their income, the interest from folks that they've lent to. A lot of those folks have pretty low interest rates. Even if they've sold off some of the debt, the commercial stuff that they've got on their book is maybe paying a lower interest rate relative to the amount of deposits. It's squeezed their spread. That's what banks live off of, is I pay you this much interest, but I charge your neighbor this much interest. And that money that lives in the middle, that's where I make my money. Well, as that gets squeezed, as interest rates are rising on what they have to pay in, and they can't necessarily raise the interest rates on everybody that's already got loans from them, it becomes more difficult to operate. Compound that with the whole work from home, pandemic, back to work thing, where office space is really kind of struggling. Commercial real estate is having quite a time, and there are a lot of banks who are on the hook for commercial real estate. And so if somebody owns a big giant office building and the thing's mostly empty and the leases start to go up, even if places were paying the lease, if the lease is now expired and they're like, yeah, we're not going to renew, we haven't been there in 3 years, who's left holding the bag? Well, the landlord, but ultimately the landlord can just kind of mail the keys back and say, hey, I'm done with this. This didn't work out for me. We've lost money on this one bank. Now it's your problem because I can't afford to pay the loan on it because I don't have any tenants. And so banks that have larger commercial real estate risk and they're already getting their margins squeezed, Moody's looking around going, hey, it's going to be tough for these guys to make money, whether that means that they have losses or just smaller profits remains to be seen. But it's a thing that's happening right now in the banking industry. As I said before, some months back when I did that video, I don't think we've seen the last of it. It seems like starting to crop up again. Hey, if you're enjoying the video today, I know it's a little different than what I normally put out. It's not specifically financial planning related, it's more financial news. But at any rate, if you're enjoying the video, go ahead and subscribe to the channel. Click the button, because if you do, you'll get notified every time we put something new out. We try to get 1 to 2 videos out a week as it pertains to retirement, saving, investing, lowering your tax bill, all of that good stuff. So if that's for you, go ahead and click the button, and I'll see you again another time. And so here we go. What does that mean for you? Well, our economy runs on credit. 2 things really drive the economy: consumption, people consuming, and credit. Businesses use credit to borrow. Folks who do things like buy real estate, they're not buying these giant office buildings in cash. They're doing it with financing. As financing gets more difficult, which has happened, it can have an impact on the economy. When banks start to see losses, they tighten up. I've actually got a video that'll be coming out about that. There's a Fed report that came out that showed that that's happening. Banks are tightening their lending standards and have been for a little bit here. And as that starts to happen, it can have a negative impact on the economy. Now, overall, the economy is doing pretty well right now, but this is a good time when you start to maybe see a potential canary in the coal mine. I'm not saying this is the beginning of a big downturn by any stretch, so don't misunderstand me. But this is a good reminder that you should assess the risk in your portfolio. Not just, is my bank on this list, but if there is a bit of a banking crisis, what's that going to do to the stock market? What's that going to do to bonds? What's that going to do to my investment portfolio? Get in there and take a look at it. Don't just go like, it'll probably be fine. Might be fine, but now is a good reminder to assess the risk that you have. And that's kind of the point of, here's something that's happening. You're not seeing a whole lot about it. That's why I wanted to do the video, to talk about it. It's a good time to assess where you're at. You might be perfectly fine with the risk that you have, but it's better to do it before than after. As I like to say, you can't buy insurance for your house when it's already on fire. Well, if we think there might be a fire hazard, now's a pretty good time to check for it rather than waiting to see if it happens and then trying to fix it later. That's all we've got today. I hope that you learned something in the video today. I thank you for being here, and I'll see you soon.